Hello, everyone. Welcome to Rising Risk, Resilient Homes, there's always a Reimagining Insurance for Communities. I'm Andre Perry, Senior Fellow and Director of the Center for Community Uplift at the Brookings Institution. It's a pleasure to kick off today's conversation with you. As a former resident of New Orleans, I know firsthand how often insurance decisions seep into everyday life. Now they're a national conversation that reaches far beyond the coast. The numbers tell a powerful story about where we are and where we're headed. In 2024, average homeowners insurance premiums rose by 10.4%, following a 12.7% increase in 2023. In Florida, non-renewals surged by 280% between 2018 and 2023. Across the nation, roughly 1 in 13 homeowners were uninsured last year. And in high-risk states like Texas, insurers denied nearly half of home insurance claims in 2024. These trends aren't just about rising costs. They illuminate the fundamental limits of our current insurance structures in the face of intensifying climate risk. But these challenges are also present an opportunity. The conversation about homeowners insurance is inseparable from the broader question of risk, how and where we build, how we measure and manage risk, and how we deploy innovations to sustain viable, affordable, and protective insurance systems. By linking community resilience with potential cost savings, we can align incentives for better construction standards, smarter data-driven risk management, and targeted investments that expand protection, not just coverage. Today's event brings together a national perspective with practical local insights. We'll explore how structural innovations and data-driven risk management can fund resilience efforts and how communities that have faced extreme weather can translate lessons learned into scalable solutions. Our aim is to outline a roadmap for building homes and communities that are safer, healthier, and more resilient without losing sight of affordability and access. After a few opening remarks, setting the frame and priorities for the conversation, we will hear from an expert panel to get a closer look at both practical and policy implications. We will take questions from the audience. Please submit your questions to events@brookings.edu. That's events with an S, plural. It's my pleasure to introduce to you two people who will help set the table and tone for the day. First, I want to introduce Manon Donahue, a fellow, my colleague here at Brookings Metro in the Center for Community Uplift. Manon contributes critical perspectives on how environmental conditions create both challenges and opportunities for thriving. And then Stuart Yasgur, founder and principal of Economic Architecture. Stuart brings deep experience in translating economic and structural insights into practical policy and design solutions that strengthen communities. And with that, I'll pass it over to my colleague, Stuart Yasgur, who will kick off some introductory remarks.
Great. Thank you, Andre. Hello, everyone. I'm Stuart Yasgur. I lead Economic Architecture, where we focus on structural innovations, the kind of market-based innovations that have the potential to address the root causes of large social problems. So we conduct extensive research. And for example, in our recent efforts, we've evaluated the work of thousands of organizations across the country and conducted hundreds of interviews. There are three things we learned during those interviews that I'd like to speak to you about today. First, there was a theme we've been hearing over and over again. The increased frequency and magnitude of extreme weather is making people feel vulnerable in their own homes and communities. And when they turn to insurance for security and comfort, the problems are compounded. For many people, insurance is difficult to get. If they can get it, it's difficult to afford. And all too often, it provides too little coverage. The second thing we learned was that people's concerns were based in facts. According to a recent study by LendingTree, there are over 11 million owner-occupied homes in the United States without insurance. And there's little doubt that that's in part because of the rising costs. As Andre just mentioned, we are seeing homeowners insurance rates increase at 10 and 12% over the last 2 years. The increased costs are also putting real pressure on homeowners, many of them whom are already cost burdened. And there are questions about whether this more expensive home insurance is actually providing homeowners the coverage they need. In a recent study by Kin, 18% of homeowners say their current homeowner insurance policy doesn't provide enough coverage to fully replace or repair their homes in the event of a loss. That finding is actually consistent with research that looked into the results of recent catastrophes. For example, research done by the University of Colorado Boulder found that 74% of homeowners who filed claims after the Marshall Fire in Colorado were underinsured. 35% of them were severely underinsured. Unfortunately, the bad news is that the problem is bigger than just insurance. In large part, the lack of insurance coverage and the higher costs reflect the fact that we live in a far riskier world than we used to. Extreme weather events are far more common and damaging today than they were before. For example, in the last 60 years, heat waves have become 25% more intense and 3 times more frequent. From 1990 to 2024, the area burned in fires each year increased by nearly 60%. And from 2016 to 2024, 29 hurricanes or tropical storms in the US each caused at least $1 billion in damage, with total damages estimated at over $820 billion by the National Oceanic and Atmospheric Association. In total, between 2015 and 2024, the United States realized more than $1.4 trillion in losses from billion-dollar events. The higher level of risk in our world today is reflected in the higher insurance costs and the more limited coverage that homeowners are experiencing. Fundamentally, if we want to lower our insurance costs and make sure the coverage is more comprehensive, then we need to lower our risk. When we recognize this, we also recognize that the conversation about insurance is really an invitation to a larger conversation about how we manage our risks. And the third thing we learned from our research that I want to share with you today, and here's the good news, is that for many of the perils we face, we have the potential to lower the level of risk through the choices we're making. Our decisions about how, what, and where we build can materially impact our level of risk. For example, fortified homes are more resilient to hurricanes. Hardened homes with defensible space around them are more resilient to wildfires. This is just the beginning. There are a number of techniques that we can use to reduce the risk to people, to their homes, and their communities. And we're continuing to learn more about how to do this in better ways. But the biggest opportunity to increase resilience is to increase the number of homes and communities that are using these techniques. For example, by increasing the number of fortified homes from the nearly 60,000 that are in Alabama today to include more of the 32 million homes that face risk of hurricane damage. By making sure that more of the 1.2 million homes that are at very high risk from wildfire today are in communities that are hardened to fire. This is not an engineering problem. It's a coordination problem. It's a large-scale coordination problem. At Economic Architecture, we believe that every person deserves the opportunity to live in a safe, healthy, and resilient home. And we believe that collectively we can make this a reality if we're thoughtful about how we use policy, regulation, and market forces to manage and lower our risk. It's not enough to mandate that people lower the risk or provide affordable insurance coverage. The scale of the problem is far too large for that. We need to be thoughtful about the innovations that can change the strategic landscape so that whenever people face a decision that has the potential to lower the risk, whether they're a homeowner, a builder, a policymaker, or an insurance executive, they'll make the decision that makes homes and communities safer and more resilient, not just because it's the right thing to do, but also because they believe it's in their own interests. We call these kind of innovations structural innovations. And at Economic Architecture, we know that collectively, we have a long history of making incredible progress when we advance structural innovations. And that is part of why I'm so grateful that we're here today for the 4th event in a series of monthly talks that are being presented by the Brookings Institution and Economic Architecture that focus on creating safe, healthy, and resilient homes. I'm grateful to be here with my longstanding collaborator, Andre Perry, and his colleagues at the Center for Community Uplift. They have the depth of expertise in research and policy that will so important to this process. I'm grateful to be joined by these remarkable panelists, Carolyn Kousky, Nancy Watkins, and Charlie Sidoti, who each have a unique expertise in insurance, which has a critical role to play in solving this problem. And I'm grateful for each of you who has joined us today, because collectively, we have so many of the ingredients we need to begin to get this done. Now, I'd like to invite Brookings Fellow Manon Donahue to join us and make some opening remarks. Manon?
Thank you very much, Stuart. Thank you, Andre. Hello, everybody. My name is Manon Donahue. I'm a fellow at the Center for Community Uplifts at the Brookings Institution. First off, I want to thank you all for being with us today. This is an important It's a complex and it's an exciting topic. And I hope that you will all enjoy listening to the speakers that we've put together as much as I do. As you've heard from Andre, as you've heard from Stuart, we're talking about insurance today. Now, that's a topic that recently feels like it makes headlines almost monthly for the worst types of things. Insurers pulling out of areas at increasing risk of wildfires, premiums increasing, and rates of claim denials creeping up. But we're not only here to talk about the insurance sector, because despite those attention-grabbing headlines, the problem isn't insurance or insurers. The problem is how we manage and respond to changing environmental risks that are amplified by the effects of climate change and that are touching an increasing number of communities across the US. So no, insurance isn't the problem, it's quite the converse. Insurance is a crucial part of the solution. And that's something our panelists today, Carolyn Kousky, Nancy Watkins, and Charlie Sidoti, understands well. It's true, right now, the insurance sector is struggling to keep up with these changing risks. Recent Brookings research by senior fellow David Wessel that analyzed data from the US Treasury Federal Insurance Office shows that between 2018 and 2022, average premiums increased by 8.7% faster than the rate of inflation. This trend, unsurprisingly, it's more pronounced in regions that are more exposed to disasters and extreme weather. Consumers living in the 20% of zip codes with the highest expected annual losses paid 82% more on average than those in the 20% lowest climate risk zip codes. 82% more. In this environment, more homeowners are turning to insurers of last resort. Another recent Brookings report by non-resident senior fellow Meredith Fowley shows that Florida's insurer of last resort became one of the top 10 largest homeowner insurers in 2023. These trends, they paint a clear picture. We need better structures for insurance, more effective financial instruments, and innovative approaches to valuing risks that can ensure that existing homeowners aren't saddled with debt and premiums don't rise to the point where homeownership becomes financially impossible for many. But we should also temper our expectations. As I said at the beginning, as Stuart said as well, insurance isn't a panacea. If we're relying on insurance to solve all of our problems, we'll be a day late and $1 short. In fact, insurance is only effective as part of a wider landscape of changes in policy, standards, and practices. Changes like updating building codes, modernizing governance structures, improving accounting methodologies, and passing laws to respond to and manage climate risks. These together make people and places more resilient. It's not just about changing insurance to suit new risks. It's about changing risks to make insurance a viable option. Now, recently, I had the opportunity to hear climate scientist Katharina Hiho speak at New York City Climate Week. And I want to end with something that she said that has stayed with me. Building a movement for climate resilience relies on moving heads and hearts. Moving the head is what people like me at the Brookings Institution work on daily, and that's providing facts and data on changing risks and identifying policy gaps. Now, moving hearts is about communicating the human stories of climate change, like the coverage around Hurricane Melissa over the past week. But Catherine also said that these two things alone are not enough. We also need to move the hands, the actions that decision makers can take today to act on what has changed in their heads and in their hearts. Without providing the tools for actions, the head and the heart are wasted. Moving the hands, that's exactly what the types of work that our panelists today are leading on. They're developing structural innovations in insurance, products, and risk reduction that can move folks to action. That's why I'm excited about today's discussion. With that, I want to hand back to Stuart to moderate and introduce our panelists. Thank you very much.
Thank you, Manon. Now I have the opportunity to, the honor to kind of introduce our panelists. So I'd like to start with Dr. Carolyn Kousky, who is the founder of Insurance for Good, a hub that enables partnerships, supports field-level experimentation, and advances the learning and innovation needed to make insurance markets more effective at promoting resilience and equity. Carolyn is also at the same time the Associate Vice President for Economics and Policy at the Environmental Defense Fund, and she's one of the most trusted voices on disaster and insurance reform. Welcome, Carolyn. Next, Charlie Sidoti. Charlie leads InnSure. It's a nonprofit hub focused on insurance, innovation, and climate risk. He's building the infrastructure, platforms, and pilot programs that help the insurance industry move from simply pricing risk to reducing it. Welcome, Charlie. And finally, Nancy Watkins. Nancy is a principal and consulting actuary at Milliman. She's a leading thinker on climate risk and community resilience. She's also building something groundbreaking, the WUI Data Commons, which is a first of its kind open data platform for wildland urban interface, and which I hope we'll talk about in a little bit. Welcome, Nancy. Great. As we start off, I'd like to invite everybody in the audience to submit questions, if you'd like to, at events@brookings.edu. That's events with an S at brookings.edu. And I know we've already had questions submitted. So looking forward to this fantastic conversation. To start off, I'd like to invite you all to correct me where I may have made a mistake. I think one of the themes that was in Andre's comments and Manon's comments and my own were that, we're clearly experiencing pain points around insurance right now, but those also reflect underlying risks. And I kind of ventured that, in order to address the insurance problem, we have to address the underlying issue of risks. What did we get right and what did we get wrong there?
I guess I'll start. I definitely think that what you said is true. And it's a big part of the problem, but it's not the entire problem. Another part of the problem is how insurance is viewed and how insurance is regulated. We have regulatory structures that were built for the past and that worked for the past and that did their best to protect consumers. But when the risk started to change, which it has, and also inflation over the past, post-COVID period happening at the same time that the risks were changing, all of those things ran into a very inflexible regulatory structure that was particularly tough in certain states that you all have highlighted, like California, like Florida, and the confluence of those things actually made the problem much worse than only the risk. So it was the catalyst, but it's not the only thing that we had to think about.
I completely agree with everything Nancy said, but I'll riff a little bit, Stuart, on your comment about the growing risk, because I think that as risk goes up, not only are our regulatory structures not built for that, like a lot of our systems aren't built for an environment of ever growing risk. And I think there's maybe a common misunderstanding about insurance sometimes that insurability is a sort of yes/no thing. And actually, it's more like a spectrum. Some things are a lot easier to insure. Some things are a lot harder to insure. Some things we really can't insure, like, global economic disaster. There's just not enough capital in the market to insure things like that. So I like to think of it in kind of two buckets. There's the technical limits to insurability. That's something like, we can't pool global risks, anything that violates the mathematical laws that underpin our modern insurance industry. But there's also economic limits to insurability, and we tend to hit those before we hit the technical limits to insurability, by which I mean insurance becomes more expensive than people are willing or able to pay. So we can't get a price that's profitable for the private sector and that we have policyholders either able to pay, they might be up against very real budget constraints, or where they still think it's worth buying the product anymore. And we've seen that happen over and over again for disaster risks going back decades. But we're also now, as the planet is warming, stressing that even further. We're making some risks so frequent that they're not economic to insure anymore. We're making some risks more severe and making that tail more uncertain, which starts to make it more costly to cover the big risks. And to come back to your point, in order to come back into a more comfortable level of insurability, we have to address that underlying risk and invest in the loss reduction that can kind of come back to making things easier to insure.
And I'll just add, I think you got it right. You laid out a vision of structural kind of innovation that touches risk reduction at potentially asset level, community level, landscape level, also insurance innovation at a product level, distribution level, capital stack level. That's a lot of innovation. And it's necessary. We think, as we work through these challenges, that the system needs to be reimagined. We need to bring risk down, but we need to do that probably using innovative approaches to risk reduction that aren't easy to quantify or fully and quickly capture in insurance markets. But that's necessary to incentivize different behaviors. And we need to innovate insurance, products, distribution, capital stacks. How do we do all those together? It really requires a very different kind of engagement model. And who's going to lead that, we think, is one of the biggest questions. That could be led from the industry. Everybody needs to participate. It could be led from the industry. It could be led public policy, federal government, states. We think one of the best places to drive it from is actually integrating insurability, this concept of insurability planning into economic development planning at a local level. Like we've been seeing, there's a lot of work to be done, but there's chief resilience officers in a lot of communities right now. They have been kind of moving towards a more robust approach to resilience. We need to think about the financing risk in that process and drive some of these changes locally.
Charlie, that is a great setup. I'd like to kind of pick up on the thread because you are each advancing different innovations that address different aspects of this. Can we go around circle and kind of share a little bit about the innovations you're developing and kind of how they actually contribute to addressing both the insurance piece and potentially the risk?
I'm happy to go. One, I think just the concept of insurability planning, when we talk to people, they conflate just resilience planning, things automatically get captured. So how do communities doing economic development planning engage with and shape a local insurance market that they're operating in? And one way we think that the capital structures too, the insurance industry is backed by very large pools of capital that often come out of like Munich and Switzerland and London and Bermuda. One of the things that we noticed was that there are these community development banks that are very sophisticated at lending into communities that look very difficult to lend into. And they do that based on hyper-local knowledge of what's going on in terms of economic development planning. We think that model for community development financial institutions could be a really good model for community development reinsurance institutions that leverage their expertise around risk in these macro trend areas about like how climate's changing risk, but also engage hyper locally in ways that captures the value of local investments into resilience. That's just one idea.
I guess I can go next. I live in California. I've been non-renewed twice, and have been working really ever since the fires started in 2017 and 2018, where we saw just a whole change in the insurance landscape as respects urban conflagration, which is the problem. It's not fires in the vegetative environment, the Smokey the Bear things that we grew up with, but it's fast fires that could even be sparked in grassland and then quickly move into urban or suburban communities where the houses become the fuel. So I'm interested in figuring out when things are changing very fast, how to start putting information in front of people to adapt to those changes and maybe rethink their decisions, and make better decisions that collectively reduce the risk. So I've been working with a couple of fire chiefs for about 4 years now to try, and insurance companies, catastrophe modelers, regulators, the Insurance Institute for Business and Home Safety, lots of different players, but just trying to figure out if the risk is changing, what do we need to know? And I think Andre said one of the innovations is to better measure and manage the risk, to better communicate the risk, and to drive collective action, which for urban conflagration, having neighborhood level mitigation is essential. Just focusing on what one homeowner can do at a time is not good enough to bend down the risk curve. So I've been working on finding a way to take parcel level inspection data and make sure that if a homeowner or a neighborhood does do significant things to reduce their vulnerability to fire, that information is visible to insurance companies so that they can get credit for it. There's this theoretical idea that if we do the things that we've been told to do, that we should get more interest from insurance companies and better premiums. And that is theoretically the right idea, but there's no practical way for insurance companies to inspect every little action that policyholders do, or especially the neighborhood around their policyholders. So I'm trying to solve that problem, and have done a couple of phases of development of this data commons idea to figure out how to drive down the costs of doing inspections and making sure that high quality data is available with privacy protections for the individual consumer so that they control who sees their individual information. But if we do that, then the modelers who ingest whatever information they can get will have a better idea of how to distinguish communities that have taken the actions to reduce their vulnerability and adapt their modeling of the expected losses from those communities. That is the most efficient way to get insurers and reinsurers to change their pricing and their underwriting and to use these models that they're already using to provide a more immediate sense of cause and effect to people who have driven down risk or people who haven't, because the lack of connection right now is causing a lot of confusion, a lot of frustration, and just an inhibition of anyone to take action.
That's great. I really agree that figuring out how we bend the loss curve and lower risk is really the priority and foundational. But I'll layer on another idea, which is we know from a lot of our research how critical insurance is for recovery, right? I mean, that's why this has become such a nationwide conversation. In our own work, we found that households with insurance have fewer unmet needs. They have fewer financial burdens in both the short and longer run. We see that insured households are more likely to rebuild, have higher self-reports of recovery, that insurance is protective to lenders, to our GSEs, that it provides greater economic recovery at a community level. There's spillovers, and there's also some sociology work that lack of insurance widens income inequality post-disaster. So insurance is really important. And when we see a response to rising risk being that more of that risk is going back onto residents, that creates a challenge because then we don't get all these really wonderful benefits in terms of recovery outcomes. And so if we see people having to go without insurance or having much more limited coverage so that when it comes time to rebuild, they don't have enough. We're seeing that after many major disasters, including the LA fires right now. So the other challenge to layer on top of this is in this world of escalating risk where we're trying really hard to lower losses, how do we also make sure that we're closing all the insurance gaps to make sure that people have the financial protection they need? And we see different types of insurance gaps. We see gaps by peril. So lots of people at risk of flooding don't have flooding. Lots of people at risk of earthquake don't have earthquake coverage. Like we tend to see peril gaps for big catastrophes. We have gaps by population. Lower income households are much less likely to have the insurance they need. Renters are less likely to have the insurance they need. And we see gaps by the type of loss. Our current insurance system is really built for property damages, for property loss. But we also see post-disaster that a lot of the losses are not property losses. They're things like lost income or revenue. They're the cost from being displaced there. We saw after Hurricane Maria in Puerto Rico that lots of households had to buy fuel and generators because the power was out for so many months. That type of thing's not covered by your insurance. So there's all these types of losses that aren't really well covered. Renters is another good one. We see right after big disasters, what usually happens is housing supply goes down, housing demand goes up. What happens? Prices rise and renters can't insure against higher rent. So there's lots of types of losses that aren't covered. So to get comprehensive coverage, there's not like a one size fits all to all those problems. We're going to need really a patchwork of different sorts of approaches to fill in all those places. And I think some very live policy conversations are, where are government created programs or government going to come in to fill some of those, and where are some going to be in the private sector? To kind of now circle back to what we've been working on, I'll just share one example. Insurance for Good is working with the city of Philadelphia and a community organization in a socially vulnerable, kind of highly flood prone part of the city. And this gets too technical, but there's a number of reasons that our federal flood insurance isn't a great fit for this community. I think our federal flood insurance program is really important, but here it's not the best fit. So we're working with them on a parametric microinsurance product that gives people flexible dollars quickly to cover all these types of losses that are actually not covered by the NFIP and that they're really suffering from. So that's sort of what Charlie was saying, like a product innovation to kind of put in the stack of the different types of innovations we need.
Yeah, that's fantastic. And I think that if you listen to each of you, like it shows kind of how much of a fertile frontier this is for innovation. These are such different, they're targeting really important different aspects of the problem with very different kind of approaches. And I think, this is just the tip of the iceberg. There's so much more obviously needed. I'm going to ask you, because if you'd be willing to share a little bit, because each of these innovations, it's not easy. It's not just coming up with the idea, like actually advancing the innovations and getting them taken up is difficult. And I think this is, the people who are joined this call today are kind of all kind of folks who are ready to contribute to the solutions. But can you share a little bit about some of the difficulty of that, i.e., like what are some of the aspects of advancing these innovations that you're wrestling with now, and who do you really need to come to the table to move these things forward? Would you be willing to share a little bit of what that looks like?
I can definitely say that for this one thing that I'm working on, the data commons, it needs to be a public-private effort to work. If it's the insurance companies getting better data, nobody's going to want to support that from the consumer and the regulatory standpoint. If this is all done, by the government, then it's very unlikely that the data would be acceptable and useful to insurance companies if they didn't have a part in the design. So I'm having to bring together parties from local communities, from the fire management. The Western Fire Chiefs Association is my best partner in this activity, because they're the trusted, knowledgeable experts that can walk the streets of the community and say, why you have to clear your 5 feet of defensible space around your house, and make sure that these inspections are trusted and unbiased. But we're also having to bring in modelers and regulators, technology companies, and then insurance companies who are not necessarily in the mode of working together, because they are competitors with each other. So this is essentially like building an ark and convincing all the animals to get on the ark and some of the animals to pay for the ark, when nobody knows exactly what an ark is. And a lot of the animals hate each other and some of them eat each other. So that is not easy. The only reason to do something like this is because there's not a better idea. Like I'm 4 years into this idea, and I've had hundreds and hundreds of conversations and done a million presentations, and everyone has said, yes, we need the data. It's really expensive to get. It will tell us what our risk is of urban conflagration. Urban conflagration is the problem that we need to solve. The models can't see what they need to see. So the local, like utilities, these utilities companies, they face tens of billions of dollars of loss, and they're trying so hard to not cause fires. But if they do, the damages are enormous. However, if they are working with communities and hardening homes, downwind from where their equipment is, their consequences go down and their ability to be viable goes up. And utilities are just going to be passing costs along to ratepayers. So there's just money moving from bucket to bucket. So all of this, it has to happen. We have to be able to convince consumers to work together and reduce their own vulnerability, but the information has to be available to do that. And that kind of change, when a lot of people are very, very resistant to change and just want everyone else to change but not themselves, that's my biggest obstacle.
I'll just add to that. I agree with everything Nancy just said, but one of the challenges on top of that, all those different stakeholders that Nancy talked about, they often speak a different language. Engineers speak very different kind of perspectives on measuring and communicating risk than actuaries do. And so even when you get people who are kind of aligned to move, they often talk past themselves, especially when you have like different types of stakeholders and kind of local versus kind of larger level. So getting people in the room and I think we've all done a lot of really good work getting people in the room, but working through those things requires some basic capacity building before you even get to the real kind of heavy lifting.
I'll add in the challenges with closing insurance gaps, because the challenge that we see constantly is demand. There are so many places you can dream up where it would be great to get an insurance payout at different times, different entities, different types of losses where it would be really helpful. It's really hard to motivate premium payments. You can't get that nice payout if you're not making your premium payments every year. And we see sometimes a lack of not so much a lack of understanding, but people kind of want to think about insurance more like investments. You can't play the insurance market, right? Like you have to be in insurance for the long haul. It's a risk management strategy. A good example, I think, was in the pandemic. I think it was Wimbledon, but I might be wrong about that. But there was an organization that had been buying pandemic insurance for years and years. And at the time of the pandemic, everyone was like, I wish I'd had business interruption from my pandemic insurance, but nobody pre-pandemic was willing to pay the money for that because it seems so remote and unlikely, right? And it's only if you constantly make those payments that you get the benefits of it. And we also see that most organizations don't like making those continual premium payments if they aren't seeing returns, right? If they're not feeling like they're getting something from it. And so kind of the sweet spot with insurance is where, I mean, you never want losses, but you get losses enough to keep feeling like it's worth it. But I think what we struggle with, where the really hard thing is a lot of our work is focused on sort of under-resourced communities, socially vulnerable areas, and lots of low and moderate income households simply don't have the extra dollars for insurance. And especially if they're trapped in a high-risk area where that insurance coverage is expensive. And philanthropy can't pay all the insurance premiums. Our public safety net for these groups is wildly insufficient. And so how we solve that problem, I think, is still, I don't think we've solved it yet. I think it's still a very active challenge. Stuart, I want to throw in one other thing though, because we've all been talking about innovation. And that's so critical. We know we need it. You've heard all these great examples of the type of innovation that's underway and that we need. But I also just want to say there's so much we can do with no innovation at all, right? We know how to build safer homes, like thanks to groups like IBHS. We know what a hurricane strong home looks like. We know what wildfire safe communities look like mostly. And we sometimes just lack the political will to be doing the investments that we know pay back, are worth it, create more avoided losses than they cost up front. We constantly struggle with a kind of political narrative, I think, that building stronger homes and stronger communities can be at odds with affordable housing, with increasing our housing supply. We know we need lots of both of those, or with getting people back into homes quickly. But to come back to this point about insurability being a part of decision making, I think Charlie raised, if we don't, homes aren't affordable if you can't afford the insurance when you're living in them, for example, right? So we need to kind of, I think, recognize that safe homes are affordable homes.
I want to like cheer and scream about this point that Carolyn's just making, because, and it goes back to why I was excited about the interview that you all at Economic Architecture did with me, I don't know, a couple months ago when we met. the structure of our financial system and the incentives and they're not aligned properly. And so right now there's this idea that because insurance is unavailable and unaffordable for many people in high risk areas, that we need to make insurance companies change their behavior, and that is really the goal. But that's not the goal. We own the risk. We homeowners, communities, business owners. It's our risk. Insurance companies is just a risk transfer mechanism. It finances it and pools it. But if the risk is too high, then we have to pay to get our way out. We cannot get that money from the insurance industry. And we can't get it from the utilities. We can't get it from Montana or the M states seem to be doing better in the climate risk issue. Like Massachusetts, I think is pretty good. Michigan, but like the low risk parts of the country are not going to pay for the high risk parts of the country, especially if they're just effectively propping up our real estate values. And so at some point we have to bite the bullet and start, I guess from a government perspective, start mandating better building codes. We've expanded too many vulnerable structures into high hazard areas. And so we've got a big backlog of homes that need to be retrofitted. The risk changed underneath us while we were building more homes in these areas. And so now we need to do something about it. And that's a very, very difficult political sell. I mean, the solutions that are popular are short-term versus long-term. They're simple versus complex. They're whatever's easy versus what's hard. They reflect a static view versus a changing view. But what we're facing is a changing view that's long-term, complex, and hard. And so we need solutions that can rise to the moment. And I think that's a real challenge.
And just on an optimistic note, I think everything the two of you said is absolutely true. Now is the time to make those hard challenges. People are feeling the pain at all levels. I don't know anybody who's like, this is a great system, let's keep it. So I think now is the time to kind of work through those really difficult challenges that Carolyn and Nancy described.
Yeah, you don't really get political will without some suffering that precedes it. And I'm not saying anything bad about politicians. I'm just saying that it's a hard job to have, and they can't lead if nobody's following them. And so you have to have the followers go, okay, I get it now. Like our insurance market is collapsing. My real estate market is going to collapse next. I guess I'm going to have to start listening and doing and supporting stronger ordinances and and reconciling myself to this new reality.
That's fascinating. Yeah, and I think that this piece, kind of, Carolyn, you started us kind of in this down this kind of road. This is, and you said it wasn't so much innovation. The one place that I would differ from you there, because I agree with everything that's been said, is that we think that this is in part the frontier for innovation, right? That what, in order to get people to buy in to move in these directions, in some ways that's the result of kind of structural innovations. Can we change the strategic landscape so that we can get stakeholders to buy in, so that we can start creating both a viable insurance market, but also reducing the risk in a way that kind of enables those economics. And so that we think that that's part of the frontier of the conversation that needs to be had, which is kind of what you led us into, which I think is really fascinating. A lot of the questions, we have incredible questions that are coming in by email, and I'd like to jump into them because they go exactly to some of these things, and I think it's so I'd love to. I'll do a poor job of reading some of these, but I'm going to try and stay faithful to what they've written. Starting with, is it maybe an interesting opening? Is it fair to assert that the traditional insurance model primarily focuses on maintaining or increasing premium income rather than reducing claims? Question. And then it's a longer piece. The cost of reducing risk is astronomical. There's no way grants can pay for this cost. Instead, we need a low-cost loan model that spurs insurers to invest in risk. At a philanthropic organization, they're developing a loan model rather than a grant model to mitigate risk. Consider a housing authority insurer in a Midwest state that has modeled investing $5 million in 1,000 hardened roofs, which can reduce anticipated claims by $5 million over 10 to 15 years. Why not have the state of California, Florida, and others establish low-cost loan investments that can be repaid over time by reducing catastrophic claims?
I can jump in to start. I want to say first, I think we need everything. We need grants, we need loans, we need a whole bunch of different ways of financing. So I don't think it's an either or question. I will say the challenge with financing this to date, and maybe given the changing landscape and the pain we're starting to see in housing and insurance markets will change this dynamic, but most people are very debt averse to be taking on resilience investments. They have gotten many opportunities to do that and have not done it voluntarily very often. And this is particularly true in a post-disaster context where there's so much economic suffering. So I think there probably is a role for loans, but it has to kind of figure out how to make that easy and something that that the borrowers are excited about taking on. So there's some challenges there. I'll also want to say, and I'm sure actually probably both Nancy and Charlie have thoughts on this, but there is this desire because investments in loss reduction lower future avoided losses. That's not a cash flow. Everybody wants it to be. So they look to insurance to say our premium reductions will be that cash flow so that we can invest in risk reduction. And there's challenges with doing that. And Nancy, I'm going to pass it to you after me to kind of add in your thoughts. But the one I'll say is that a lot of our investments in risk reduction are they have very diffuse and broad benefits. Yes, they help the homeowner, but they also help their neighbors and the community and their lenders. And so one individual insurance premium isn't going to be sufficient to cover that. But I'm sure both my panelists want to talk about that.
Yeah, I'd say for certain perils, that kind of a model certain perils in certain areas, that kind of model can work. For example, in very high hurricane areas, where the premiums could be, extremely high relative to the value of the house. If you replace the roof, you might have changed the risk profile of the house quite dramatically for not a huge amount of money, relative to the value of the home and the cost of the premium. And so you might be able to pay that back in, 3 years, 4 years, 5 years. That's a model where I think you could have, and I used to work with a company that did the insurance for several years. They had financing and they had a construction company that could replace the roofs, and it's all sort of packaged up together. The problem is for other, like you move a little bit away from the highest hazard areas, and that payback period is not just a couple of years, it's many years. And then you've got this relationship with an insurance company that's typically renegotiated on an annual basis. If you've already got your roof in year one, and your insurance company is looking for a payback, they have to actually charge you more premium than their competitors could charge, Carolyn with a new roof. So there's a mismatch between who paid the cost and who's financing the cost and who's getting the benefit and the time period of the relationship. With wildfire, it gets even worse because there's such a high cost of restoring. We're having to change how we think about the buildings that we live in and the defensible space around the buildings, and trying to move into a less vulnerable posture could cost a fair amount of money the first time you do it. And an insurance company premium payback is unlikely to have any relationship to that cost. However, the city of Berkeley just implemented a Zone 0 ordinance. That's the 5 feet around the house, requiring their residents in a very, very high risk neighborhood to clear the 5 feet of vegetation that could burn, not big trees, but like plants that are smaller and that could burn. And they're offering collective negotiation with contractors, landscapers, and an ability to securitize the cost and pay back when you sell your house. So there are new models that could come in and fill this gap and just recognize that when you have a whole neighborhood doing something, that's high impact, which is great, and it can have efficiencies built in that can allow the costs to go down and to be financed over time. The insurance industry paying for this, though, I don't think is a realistic expectation. I think the towns and the states are more likely sources.
Great. There are so many questions coming in. I'm going to bundle a couple to put some on because, frankly, I'd love to talk about each of them, but let me name just a handful. One of our participants asked, I'm intrigued by Nancy's statement that the regulatory infrastructure is outdated and has become a significant impediment to insurance. Can we ask what are the regulatory changes she would prioritize? And I'm going to name maybe a couple of questions to put them out, Nancy, and then we can. So that's one likely piece. We had another question: are there already any local U.S. governments that are providing homeowners insurance for residents? Then, what are pending insurance changes related to wildfire risk? So it's a little bit of a grab bag, but I just wanted to put a few pieces out and kind of offer you the opportunity to comment because we're coming to our closing last 10 minutes here.
If I said our regulatory structure was outdated, I didn't mean to say it that way. We have a state-based regulatory system, and it's got pluses and minuses, but I think state management of hazard and insurance makes a lot of sense. A lot of the decisions that are made for zoning and building and taxation are at the state level, and managing your insurance market at the state level kind of brings a lot of the control together, and I that has a lot of appeal to me as opposed to like a mismatch between federal and state. However, some states have focused on keeping premiums down for everyone to the exclusion of anything else. And that's like saying no matter what your health condition is, you should be on a diet. Now, maybe some of us do need to be on a diet, but if we just got shot in the, in the stomach, that's probably not the thing that we need to be dealing with. So states that outlaw, models and data that insurance companies want to use to understand the risk better because they feel like those models and data, are something they don't understand. That's a problem. So the regulators. I work a lot with individual insurance commissioners. Some of them are my clients, and they try very, very hard to stay on top of things. And so they need more support and education for their staffs on new models, new technology. But I think, different states are going to suffer if they are using old regulatory frameworks that aren't compatible with this changing risks, and they are changing on their own. California has, Florida has, and they're seeing better outcomes. It just takes a while.
I would just add quickly, I think the regulators should be tasked with the mission that Carolyn talked about earlier. They're not tasked with closing the protection gap and actually financing the risk. If that was part of their mandate to work on that problem, they would look at the problem in I think a different way.
Great. What is your proposed solution for property owners to remain financially protected when risk data and predictive models show their region to be unprofitable for a private insurance company? And adding just a couple more there, what are pending insurance changes related to wildfire risk? I think I mentioned that. And then what can be done to prevent widespread claim denial? So these are provocative questions.
I'll kind of offer that I think the answer to several of these is what we've been talking about. We need more investments in lowering the risk. If you're not profitable anymore, then your risk is high. And so the answer is to invest in those things to lower your risk. Now, the question is also then, coming back to this idea of changing the institutional structure to make that easy for people. Sometimes right now it's not easy to understand what are the measures you need to adopt. How do you finance that? How do you get it done? There's a lot of frictions in getting that done that need to be eased for consumers to make that an easier process for them. And to link it to the question about regulations around wildfire, for instance, California a couple of years ago required that insurers adopt premium discounts for different types of wildfire mitigation measures. But for a long time, wildfire mitigation has been this like long checklist. People are not good with long checklists. They either it's like too much or they think, oh, I can just do one of them, but you can't just do one of them. And so things like these comprehensive standards, like the wildfire prepared home that's coming online that can kind of help people through that, I think is important. So we need the kind of regulation to support it, but also we need to close these information gaps and these frictions.
Yeah, I would add that states, and this is not an insurance regulatory issue, it's the risk mitigation issue. Most states do not have any real planning framework. Like I'm working on an article with several other people that I know who to show what a state framework for wildfire mitigation would look like. In the absence of a plan, what you have is activity. And the activity might be valuable or it might not be valuable. So the way that activities for fire are measured are like number of acres cleared or number of dollars spent or number of volunteer hours expended. That's not telling you anything about effectiveness. Acres where, and like dollars spent how, and volunteer hours doing what. That it's an indication of activity, but not outcomes. And we don't have unlimited resources to do this. So we need to prioritize the most effective mitigations and drive those investments, which will help the lower income areas if they're in the highest risk places. And we can, bring the resources in and get more bang for our buck. But you have to have the state planning this from a holistic perspective, or else, you're just lucky if it works out. It's not really a plan.
And I think that's going to have to be the last word on it. Maybe a great kind of summarizing line. As I think, thank you so much for this fascinating conversation. I feel like we've just even barely started to scratch the surface here. I'd like to thank each of you, Carolyn, Nancy, Charlie, for your time and sharing your thoughts today. Andre's here, which is great. I'd like to, if I can, Andre, I'd like to thank you and your colleagues, Amanda and Anthony Fiano, who's not here with us on camera, and Krista Lanning, who do an incredible job of putting this all together. It's phenomenal. And also I'd be remiss if I didn't thank some of my colleagues at Economic Architecture, including Dr. Jennifer Vode and Devaney Smith and Lisa J. Cox for bringing this together. Thank you, everybody. Andre, over to you.
Yeah, such a rich and powerful conversation. What's clear to me is that the greatest risk that we face is not working together across race, place, industry, from regulators to grassroots community organizers. We have to work together. There are solutions that we can have, but it won't happen unless we work together. Again, to all our panelists, especially our audience, but I need to send a special shout out to our panelists, Carolyn Kousky of Insurance for Good, Nancy Watkins, Milliman, Charlie Sidoti, InnSure, and of course, Stuart Yasker of Economic Architecture, and my colleague and friend, Manon Donahue, fellow at Brookings Metro. Again, thank you all for tuning in. You can find more events like this by going to the Center for Community Uplift website at the Brookings Institution, and always sign up for our newsletters and other correspondences. Again, thank you. I'm Andre Perry. I'll be seeing you soon.